Hi, and welcome to Unconditional Webcast, brought to you by realestate.co.nz. This week we decided to make it a bit of a discussion, and I'm joined today by Shamubeel Eaqub. He is the Chief Economist at the New Zealand Institute of Economic Research, and this provides an opportunity to have a discussion about the economic position of the market, particularly around property. So, Shamubeel, thanks for joining us. Thanks for taking the time to come join us today. And I guess this is a good chance to talk about the property market from an economist's perspective. So you've just done your research on the third quarter and the state of the economy in New Zealand. Do you want to just give a brief overview to how you see property in the context of the economy at the moment, and then we can get into discussing some of the drivers of the economy?
Well, thanks, Alistair, for asking me to be here. It's a pleasure to be here. I guess we could start with just the overall context of the economy. It's been a very painful recession. We had quite a big drop in terms of activity. We've had job losses. We've had house sales that are very weak. And it's been a big downturn that we had through 2008, 2009. And 2010 has been really kind of a sideways shuffle. While most people have called it a recovery, we really haven't moved upwards. We just haven't fallen.
True.
And from that perspective, property has been no different. And in fact, property is a leading indicator of what is happening in the rest of the economy. Property is one of those things, and it's one of those purchases that is so affected by what's happening in the economy. Now, what's happening to net migration? What's happening to interest rates? What's happening to confidence in the economy? These are all very important factors that go into making the decision to buy a house. And what we've seen is house sales will lead the economic cycle by about 9 months. And house sales have slumped in the last 6 months. They're now at the level quite similar to what we had the worst of the recession in 2008. And this was deeply concerning to me. The level of house sales, the volume of sales, is so weak. It says there is real demand for house sales. And this is not just confined to house sales, right? This is what's happening in terms of retail spending. This is what's happening in business investment. This is what's happening in commercial property. This is a reflection of what is happening in the economy, which is not much. It's just this we're all sitting on our hands, waiting for something to happen.
So that's where we are, and that's where we come from. Are there any indications going forward in the next 6 months, for example, that give us a sense of we're beginning to turn a corner, we're beginning to see some improvement? There'll always be risks. That's the nature of an economy. It's the nature of an economist's role to project forward with certain degree of certainty and uncertainty. What might be ahead?
Well, I guess really the big drivers for the next 6 months is, from a property perspective, we've got interest rates, I think, that will be quite flat. Fixed interest rates are probably drifting lower. Interest rates on average are drifting sideways, which should be quite supportive and give us a bit of a reprieve.
So the confidence that the interest rates might not, at least in the next 6 months, change much from where we are today.
And the communication from the Reserve Bank has been quite encouraging, right? After the interest rate increases in June, which were clearly a mistake, it seems very clear now that they're less interested in raising interest rates and curbing the economy. And also, we've got net migration that seems to be stabilizing at a positive level. And this is really important.
We need that.
Oh, absolutely. I mean, if you think back to the recession, we were really saved by the fact that we had net migration that was positive. If we didn't have that, I cannot tell you how terrible this recession would have been for New Zealand.
Really?
It would have been so much worse.
Right, okay.
Rather than -2, we could have been -4.
Right.
And, that's not the difference of house sales at $1,000 or whatever. This is the difference between house prices not falling and house prices falling. This is a big difference. And I think what we had with net migration was this level of support that really gave us an insulation from the global financial crisis. We were very lucky because we had the housing bust first, then we had the global financial crisis, and then we had the recovery. What would have happened if we didn't have net migration is we would have a housing bust, a second leg of weakness in housing at the same time as a credit bust with the global financial crisis. I think that would have been really painful in terms of forced sales, in terms of house prices, and in terms of the uncertainty and the dislocation that could have happened.
You mentioned that mortgagee situation of forced sales. We saw a massive effect of that in the US, and just unbelievable scale of that. We've had a degree of that, and it's come through, but it's never been a significant percentage of all sales. No, but it is working its way through the system. Does that give a sense that we are more rational in the property market in this country, or we're more prudent, or we just have better banking systems to support the decision of credit which come through?
I think the New Zealand market is just a little bit different. We don't have non-recourse loans. You can't just walk away from your home. And I think the kind of adjustment that we had in the US, where you just sweep the floor clean, house prices fall, we just move on. This is the reset button, and this is the new base. You can't do that in New Zealand. That's not how it works. Most of the people in New Zealand who have debt can actually afford to make the mortgage repayments, because most of the people who have debt are actually high-income earners in New Zealand. It's not low-income earners who have the mortgages, which is what happened in the US in terms of the housing boom there. It was led by subprime, led by people who couldn't really afford those mortgages. In New Zealand, we never had that problem. We had people who could afford it. And hence, what we've seen is mortgage sales, while they have crept up, the level is really quite minute. I mean, we're looking at less than 10% of sales that are mortgage sales.
Oh yeah, it's never risen to anything of that scale on a comparative basis. It's a segment of the market, but it clears itself pretty efficiently because there are people who recognise the appeal of that, and banks need to clear that off their books.
And I think this is a very important driver in terms of why we haven't had a massive downturn in terms of house prices. We've had the adjustment in terms of house sales where, at the current price, I may not want to buy a house. That's fine, that's my choice. But if you were a forced seller, you didn't have a choice. You just had to get rid of it at whatever the price was.
What the market would take on that property at that time, yeah.
But in New Zealand, what we've had is kind of sellers who are willing, but they don't have to sell. There is no necessity in terms, there is no forced selling that's going on. And because of that, we haven't seen a huge downturn in house prices. We haven't seen a huge sort of backlog of sales. What we've seen is kind of this sort of people testing the market out, but not really that serious about making that sale. I think we're going to see this for a long period of time. People who've been in the property market for a while will remember pretty much the first 6 to 7 years of the early 1990s. Following the stock market crash in 1987, what we had was this extended period of house prices going sideways. And what we had was fundamentals catching up with house prices.
Right.
It's not house prices going to fundamentals. There's a huge difference between the two. One is very slow and gradual, and the other one is incredibly painful but quick.
Yeah, it clears it out, and then move on from there.
But
you think we could be in that kind of situation again?
I think that's
exactly
what's happening.
We're going to go sideways for quite a bit of time whilst the fundamentals catch up and property does not depreciate to readjust itself to bring about a change. Because going back to that period in 2008 when we had this correction, we didn't see the scale of price falls as was seen overseas. I mean, it barely reached 15% as a decline from the peak. It's still below the peak, but we adjusted it, as it were, in volume terms by taking property off the market. Now, the interesting thing is, are we in that situation again today? Because back then we had 50-odd weeks of inventory, and from our latest figures at the end of November, we're back at 52 weeks of inventory. Is that pressure going to cause a reaction in price, or are we going to see people pragmatically saying, I'm not prepared to readjust the price of this property on the market, and therefore I'll rather take it off and wait? Have you a view on that?
I have lots of views, Alistair, and you know that.
Yes.
But really, I think what's going on is we don't have forced sellers in New Zealand. So I don't think we need to see house prices really falling for an adjustment to happen.
Right.
I think the adjustment that we're seeing is people not selling and people not buying. It's a strike. It's a Mexican standoff. Nobody really wants to do anything at the current level. And the fact of the matter is we don't have to, right?
There are drivers which force people to move. Economic factors, jobs, death, divorce, and debt are the big three Ds in the property market that never go away.
And we have those house sales happening.
And that's probably the 3,500 out of the 4,000 potentially, in some ways you might say. Yes.
The kind of house sales we have now, I think, are the absolute necessity house sales that we must have.
Yeah. Yeah, because there's almost a natural churn has to occur.
Yeah.
People do have the need to move. Yeah.
And I think it's that natural level of sales that we're seeing, but there is no discretionary sales, really.
Right.
I mean, how much investment property is moving hands?
Compared to a year ago, 2 years ago, I wouldn't know percentage, but it's got to be a significant less amount.
Exactly.
Than it was
Look at
2
the
years
type
ago.
of properties that are selling. How many apartments are changing hands? How much of the sort of single units are changing hands? There is very little activity in that segment of the market. All the activity that is happening is kind of at the top end, which is quite insulated from the economic cycle. And if you're rich, you're rich.
Yeah, and that's why the median house price is holding.
Yeah.
Whilst if you look at the stratified price, there are some slippage in that because it better identifies that upper end, pulling the median up at times. Would you agree with that?
Oh, absolutely.
Yeah.
And with house prices, it's such a weird measure, right? What is a house price? My house is worth what it is to me. There is no one particular price for any asset, right? It's only as good as the next buyer.
Right.
The problem is there are no natural buyers for many properties right now. If you have a low-quality housing in a low-quality suburb, chances are it's not going to move.
Yeah, because of the situation, financial situation, and the lack of investor market in those kind of sectors, I guess.
There may be no price that moves that property right now. But that doesn't mean the property is worthless.
No, far from it. But
it's just that it's not worth...
It can't be worth anything at the moment. It's judged by a price that is
Exactly.
a sale transaction value, yes.
So I think what we're looking at now is this period of everybody kind of sussing out the market. We're all trying to figure out what's going to happen next. And my feel is that what we're going to see for the next 6 months is a period of quite a bit of weak activity, quite a bit of uncertainty. And we're going to see more kind of uncertainty on jobs, particularly if you're employed in retail, construction, some of those cyclical parts of the economy. And I think that's going to take some of the edge off in terms of demand. But when we look at 12 months, when we look at 24 months, I think things are starting to improve. You look at the underlying trends in the economy, and things are starting to lift, and from a new base. I think what happened in the recession, and the reason why it was so painful, was because we pressed the reset button. We went from this borrow and spend model to one of where we're saving and we're being more conservative. And the way that I like to think about it is, last year I earned $100 and I spent $110. This year I'm earning the same, but I'm spending $90. The difference is huge if you are reliant on my spending, right?
Yeah,
because last year I was spending 110 and this year I'm spending 90. All of a sudden, instead of supporting 10 retailers, I'm only supporting 8. And it's that big step shift, that big change in terms of the level of activity in the economy that we've just experienced. But once you've made that adjustment, once you're living sustainably, you can start to grow, right? I mean, your income's still rising, slowly, but it's still increasing. Employment is rising. Everything is kind of moving in the right direction. And we can see that happening right now. We can see it in retail sales. We can see it in GDP. That instead of that big decline we had through the recession, we're now kind of going sideways to slightly up. And that momentum is going to build over the next few years. And part of it is going to be helped by the fact that interest rates are going to be on hold for a long period of time, the fact that exchange rates are going to hold up, making imports cheaper. There'll be a whole bunch of things that will kind of help us recover us from the worst of the recession. But it's not going to be easy. We're not going to go back to the kind of growth rates we had before the recession.
Shamubeel, thank you very much indeed for joining us today and for contributing your insight. We'll pick up more of this again in the future.